And everything Trump is talking about is inflationary, whether it be tariffs, which will mean higher prices to the consumer, or whether it be an inflationary policy, a weakened dollar, low interest rates. These all mean softer purchasing power. So I would say inflation is here, and you can see that the bond market sees that. That's why rates are going higher. You know, by 2031, 100% of income tax revenue, according to the Congressional Budget Office, goes to just to pay the interest on the debt and mandatory entitlements, which ironically are off balance sheet. Social Security and Medicaid and Medicare, he won't touch those. He already said that. So, you know, inflation has to stay here because no one wants our treasuries at these rates.
The US dollar reversed a sharp decline against most major currencies on January 6th after US President-elect Donald Trump denied reports suggesting that his tariff plans would be narrower than initially feared. This denial helped stabilize the currency, which had been under pressure as traders with long positions in the dollar faced volatility. The Bloomberg Dollar Spot Index ended the session down 0.6% after dipping more than 1% earlier in the day. The initial sell-off followed a Washington Post report that Trump's advisors were considering a tariff strategy focused only on critical imports rather than the broader measures previously expected. Meanwhile, inflation has remained a persistent issue in recent years, primarily driven by the COVID-19 pandemic and the ongoing war in Ukraine. In November, inflation rates in the US, 2.7%, Eurozone, 2.2%, and UK, 2.6%, rose, underscoring the challenges central banks face in meeting their target inflation rate of 2%. According to Luis Oganes, head of global macro research at JP Morgan, one of the biggest obstacles to global economic growth is the uncertainty surrounding potential policies under the second term of former U.S. President Donald Trump. If Trump's economic strategies, such as tariffs and policies to weaken the dollar, are reinstated, inflationary pressures will likely intensify. In addition, the U.S. continues to grapple with soaring national deficits and debt, which create long-term challenges. Andy Schectman, CEO and president of Miles Franklin, emphasizes that these policies, combined with growing national deficits and escalating debt, will only heighten inflationary pressures. Despite efforts to reduce spending, the U.S. continues to run annual deficits exceeding $1 trillion, perpetuating a cycle of borrowing. Projections suggest that by 2031, income tax revenues may be fully absorbed by interest payments on national debt, underscoring the urgent need for structural fiscal reform to address these imbalances. We will present clips from Andy Schectman's interview. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Certainly inflation, we all know what that should do for precious metals prices. Trump is even talking about putting tariffs on metal that comes into the United States, which this is one of the reasons you're seeing, again, this big spread between the exchange for physical price and the spot price, where if you have to exchange it for physical across the globe, it's going to be a whole lot more expensive right now, fearing these tariffs. In other words, if they wanted to buy a contract here and exchange it for physical and take it back to the United States, the premiums have blown out because the fear is that once he takes office, he'll put tariffs on precious metals imports as well, which would push the price up tremendously. Inflation, obviously, the price should go much, much higher, and that's really what the whole premise of owning gold is. It's in silver. It's not that gold and silver are going higher. It's that the dollar is being inflated out from underneath us. I asked Judy Shelton the other day in my interview with her, I said, who came up with this boneheaded idea of a 2% mandate? Why not zero? Because with a 2% mandate in 10 years, you've lost 20%. I said, you know, my father I'm sorry, this little dog is insane and she's all over the place. He graduated college in 63. He was married at that point, my mother, and he said, I made $6,500 a year and I could live comfortably on that. Your mom and I could live comfortable on that in 1963. So, you know, have things gotten that much more expensive, or has the dollar lost that much of its purchasing power? So when we look at you look at, imagine this was real. This is fake. It's a bank. But imagine a COMEX 100-ounce gold bar in 1974 when the exchange was founded. Gold was $42 an ounce. So, 42, it would have cost you for a 400-ounce gold bar like $14,000 to buy a 400-ounce gold bar in 1974. Well, what does it cost today? Is the price of gold go that much higher to where it's almost 1.1, $1.2 million? Or did the dollar lose that much of its purchasing power since 1974? My dad bought a Corvette in 1973 for $6,500, a Corvette Stingray. Now they're 116. The point of it is that over time, inflation is an insidious tax on your wealth. And so what gold does is it doesn't go higher. It retains its value in an inflationary environment. And everything Trump is talking about is inflationary, whether it be tariffs, which will mean higher prices to the consumer, or whether it be an inflationary policy, a weakened dollar, low interest rates. These all mean softer purchasing power. So I would say inflation is here, and you can see that the bond market sees that. That's why rates are going higher. And with all things being equal, even if they are able to trim $2 trillion off the deficit and off of the stupid spending of the government, that still leaves over a $1 trillion deficit every year. We're not addressing the root problem, and that is the fact that the deficit keeps adding to the debt. And by 2031, 100% of income tax revenue, according to the Congressional Budget Office, goes to pay the interest on the debt and mandatory entitlements, which ironically are off balance sheet. Social Security and Medicaid and Medicare, he won't touch those. He already said that. So, inflation has to stay here because no one wants our treasuries at these rates. So if rates, and that means rates have to go higher. That hurts the economy. That hurts the banks. And if not, that means yield curve control. That means printing money out of thin air to buy bonds. That's Weimar Republic. That all leads to the same road. And, who knows when this all happens? They've been masterful at being able to keep the ball up in the air. But speaking, just speaking practically, at some point, the jig is up. So, yeah, for the people who are retiring right now, I don't know. I would be more concerned about their kids, people our age who, things may be a little bit different over the next 5, 6 years. Yeah, there is certainly reason to be optimistic, but we're talking a long road to hoe to bring back manufacturing, to bring back the things that made this country great, and to get there, it's going to take maybe a reset, and short of that, a whole lot of debt restructuring, which is not going to be easy. It's going to be painful. So, inflation is here to stay, and it's not going to go away. And with that, that would mean higher interest rates. And so all of these complexities that we have to think about, to me, all boil down to kind of one thing, and that is that over 20 years, the suppressed interest rates created massive, massive illusions and distortions in asset prices. And people are not prepared to understand what those asset prices really are when they find equilibrium with the rising interest rate environment. So, I guess I wonder every time I have these discussions, is this why Trump is here? Is he here to orchestrate a controlled demolition because he is the expert of bankruptcy and restructuring? Does he know, and do his advisors tell you, we're screwed? We're so far down the rabbit hole, there's no way out. So we can manufacture this implosion. And what does that implosion look like? What does he roll out? Does he roll out constitutional money, or does he roll out the CBDC? And that would be the question. Is he on the horse, or is he the Trojan horse? If he's the Trojan horse, then they roll out the CBDC is what that's what the Davos folks want. And that's what the WHO wants. And that's the Klaus Schwab. That's what they want. They want a central bank digital currency. Or do we go back to constitutional sound money? Do they revalue gold? Do they have a Bitcoin strategic account and revalue gold and have assets that allow them to create a new monetary system based off of commodities with a marriage of blockchain technology? Maybe. And I hope people understand that I voted for Trump, and I thank God he's here. But if you don't question this stuff, you missed out on everything that we've been through in the last 4 years. And you have to ask yourself, the dude is the expert of restructuring and bankruptcy. No better person to bring on board. Bring on a cabinet that inspires, unity and patriotism. And we did all we could with Doge, but boy, we're in big trouble. And we all got to do this. And here's what's going to happen. And boom, we transition into a new system. And again, do we bring out gold and silver backed currency with the or a commodity backed currency using distributed ledger technology, or do we go to a CBDC? These are the questions that have yet to be answered, but people should ask themselves that, even if it's only a minute possibility. In 2019, if I told you any of the crazy stuff that went down over the 4 years was going to go down, you would say, I bet you everything I own that none of that happens. And look what we lived through.
Under the Joe Biden administration, the dollar-centric financial system has faced increasing challenges, with the US dollar weakening due to several strategic moves. Central banks worldwide, particularly in nations like Saudi Arabia and China, have taken advantage of this situation by quietly expanding their reserves of gold and silver. In December alone, more than 45 million ounces of silver were delivered off the COMEX, highlighting the shift away from reliance on the US dollar. Countries have been strategically acquiring precious metals, often through direct purchases from mines or military channels, to safeguard against volatility in the dollar and the broader economic uncertainty. This trend of accumulating gold and silver signals a broader strategy to reduce reliance on the dollar, reflecting a significant shift in global monetary policy. Andy Schectman, CEO and president of Miles Franklin, has noted that this growing interest in tangible assets such as gold and silver highlights a transition away from the dollar as the world's reserve currency. Judy Shelton, a respected economist and former advisor to President Trump, also suggests that we may be heading toward a future where gold-backed currencies and stablecoins play a central role, further diminishing the dominance of the US dollar in the global financial system.
That I'd like to mention too, in my interview with Judy Shelton, I asked her some tough questions. And I said, what about the gold not being audited? And she says they always come up with these stupid excuses, too expensive and logistically challenging. And she's like, that's hogwash. Where the United States spend a few $1 million and get it audited. And that's what she would advise. And I asked her about revaluing gold, how Cynthia Loomis, she said she's a big fan of Cynthia Loomis, Senator Loomis from Wyoming, and an advocate for what she's talking about, revaluing gold. She didn't go out and fully say it, but she more or less said, yes, that is a strong possibility, and that they would issue, she believes, on July 4th, 2026, which is the 250-year anniversary, they will issue, Trump will issue 50-year treasuries pegged to gold. And then she said something very interesting as well. She said, and then I could see stable coins being issued backed by the 50-year treasury collared with gold. And this is a woman who could very well be in the Federal Reserve. She was an advisor to Trump. He wanted her to be the head of the Fed. She's very smart. And I think the bottom line is that when I look at everything I see all this talk of crypto and profit and greed and risk on, and the central banks are doubling down on their gold acquisition. Hand over fist. And 45 million ounces of silver delivered off of COMEX, either through flat out delivery or exchange for physical in the month of December. Who's got that bread? Where's it going? So we're getting to a point where I think these countries, and they're going out of their way to hide it. Saudi Arabia got busted for not reporting it to the IMF. Sorry, we made a mistake. Well, the import-export numbers outed them. Same thing with China. A recent article just came out in Reuters the other day saying that they think that the numbers they've been buying are 10 times understated. 10 times. And that they have never stopped buying all along. When they said they took those few months up, no, they didn't. They just were hiding it and buying it directly from the miners or buying it through the People's Liberation Army. So you see a concerted effort to hide the de-dollarization and to mask it. And after what the BIS did to the BRICS nations at the 12th hour by pulling out of Enbridge, saying we can't work with a country being sanctioned, forgetting that Russia was the R in BRICS, after 4 years of working with these countries to develop it, I don't blame them for being less than forthright. But the one thing that I see through all of this is that the central banks keep buying gold and possessing it, repatriating it. And when I hear someone like Judy Shelton say that's in our future, then I would simply say, especially for those retirees, if you've made a nice profit along the way, get the hell out. What do you got to lose? A lot more than you have to gain. And especially when markets are at all-time highs and the insiders are selling 6 to 1. What more do you need to know? And that would be my biggest piece of advice. And everyone is so infatuated with risk on. That's the exact time. If you were having a beer with Rick Rule right now, he'd say that's the exact time to move the other direction. And that's what a contrarian does. So one of these times, this broken clock of ours will be right. And even though gold was up 30% this year, it feels like it didn't do anything, right? Because we live in this instant gratification,
Mhm.
triple your money in 3 week environment that's going to hurt a lot of people because that's what they believe investing is. And my whole career, 35 years, says, no, that isn't what investing is. And no, this isn't different this time. Um, I think there's just a lot to be cautious about, truly do.
What people should be thinking about and perhaps taking proactive steps to mitigate risks to their retirement. And we can talk about any different aspect of that. Some of the ones that come to mind include the banking system and bonds and the stock market volatility, et cetera. So what comes to top of mind for you with the incoming administration and the policies that are that we've been told are likely to be put in effect on
When I follow who's been buying gold, I look to the central banks. When I see what's going on in the stock market, I see the insiders selling at a 6-to-1 clip versus buying. In other words, corporate insiders are for every one purchase, there's 6 sales. And you look at guys like Bezos, who sold 12.5 billion recently, Zuckerberg, who sold 2.5 billion worth of Meta. You look at the Nvidia insiders selling over 2 billion worth of sales. This is all year to date, but just between Zuckerberg and Bezos alone, you're at $15 billion sold. And if the economy was roaring and we would expect the stock market to continue on this massive train moving forward, you wouldn't see that happening. And so as corporate execs are cashing out, individual investors aren't. That's a premise that I would start with, that I would be very nervous. I think we can look at the bond market, which in and of itself is getting nervous as inflation concerns are again reemerging, and they really never left. I mean, the Fed pivoted, um, at 65-70% away from their lofty target rate. Was making a joke about this the other day. You're taking a cross country trip from California to New York, and you stop in Omaha and say we're there. We're 70% of the way there, but that's okay. That's good enough. And the point of it is that they haven't signaled victory on inflation. They've waved the white flag on it. And we can see that happening as the 10-year Treasury keeps going higher. In fact, the 20-year Treasury, which is something we really don't talk about very often, eclipsed 5% here just the other day. That's a big deal. That's a problem. We're getting into that point where the economy is going to start to shake and rattle. And we're seeing that with all of the longer duration maturities. And so what does that mean for the economy? What does that mean for the bond market, for the ballooning U.S. debt? And what does it say about the flood of new Treasury securities that the government's going to have to sell? Who's going to buy them? Does that mean higher rates yet still? Are we in store for a yield curve control, which will again exacerbate inflation as we create money out of thin air by the Fed to buy the debt because no one else wants to buy the debt? And then you look at all of the metrics by which we gauge, are we heading into a recession, which would negatively impact stock portfolios and whatnot. And by every single metric, and then some, we're there. The reinversion or the uninversion of the yield curve, the Claudia Sam rule, the increase in money market holdings, which is up to over $7 trillion. All of these things have accurately predicted recessions in the past. And so if I were at that point where I'm very quickly going to be receiving money out of my retirement, I would not have a problem with pivoting. I would not have a problem with selling all of those stocks in my IRA that I made a lofty profit on. Get the hell out of them, just like the big money is doing, before something happens that forces you to get out. Get out now, and I would layer it into incredibly short duration treasuries. As crazy as that sounds to me, I don't know where else you go where you can feel safe and sleep well at night in a market by every single metric is classically and historically overvalued and the insiders are bailing ship, and the long end of the bond market moving higher, where the banks who bet again that wouldn't happen are going to be on the wrong side of that bet, especially if rates really start to move higher, which I expect that they will.
Gold started 2024 at $2,046 per ounce, and by January 1st, 2025, its price had risen to $2,622. This surge comes amid growing concerns about the stability of the U.S. dollar, especially after the U.S. government froze Russian assets in 2022. In response, many countries have been moving away from the dollar as their primary reserve currency, seeking alternatives to mitigate their dependence on U.S. financial policies. Gold, a historically trusted trade settlement mechanism, has emerged as a preferred option for many nations. However, the transition to a gold-backed system presents challenges. The global supply of gold is limited, making it difficult to settle the vast volume of international trade that might be demanded if countries pivot away from the dollar. This situation could become even more complicated if the U.S. stock market, particularly tech stocks, experiences a significant correction. If the AI hype cycle proves unsustainable and the tech bubble bursts, there may be an increased demand for gold as a safe haven asset, further straining its availability. Such a scenario would be critical to watch in the evolving global financial landscape. Do you think gold will eventually become the cornerstone of a new global financial system? Let us know your thoughts in the comments below. If you enjoyed the video, be sure to share it and hit the like button. Thanks for watching, and don't forget to subscribe for more updates.